Hi, my name is Cary Stamp. I'm a certified financial planner and the founder of Cary Stamp and Company. I'm going to share with you today some ideas that we use with our clients to help them reduce their income tax liability in retirement. But the first thing that you need to understand is that there's a strategy. It's called tax diversification. Just like you diversify your investment portfolio, you also need to diversify your investment accounts into tax-deferred, tax-free, and taxable accounts. If you will use that information, we can determine exactly how much tax you're going to end up paying in retirement. Think about some of these things. In retirement, you're going to have an income tax. You will pay income tax on anything that's generated if it comes out of a retirement plan, like an IRA or a 401k, if it comes from employment, or it comes from some source that generates ordinary income. You'll have capital gains taxes. If you make investments and you sell those investments, you're going to have a capital gains tax. It could be 15 or 20% of anything that you sell. And then if you do sell those things, you're going to pay a little bit extra. That's called the net investment income tax, which means that your capital gains, which we thought were 15 to 20%, are actually 3.8% more because you pay this additional tax. And if you make over a certain amount of money, up to 85% of your Social Security will also be taxed. And that certain amount of money isn't a very high figure. So here's some things to think about in retirement. One way that we can reduce your tax liability is by every single year, when you have the opportunity to do so, funding a Roth IRA. Presently, you can put $6,000 into your Roth IRA if you're under 50 and $7,000 a year if you're over 50. But that's not all. If you have a traditional IRA right now, you can also convert your traditional IRA, pay the tax, and move it into a Roth IRA while you're still working. This may or may not make sense, and we have software that will figure out the maximum time to do this and exactly how much you should convert every single year. So a Roth IRA, when you retire, is an account that you can take money out completely tax-free. No tax on the money that you withdraw and no tax on any of the earnings. So if you put in $100,000 and it grows to a few $100,000 and you take it all out, zero. That's your income tax bill. I'm doing something like this. The second strategy that we'll talk about is tax-free cash value life insurance. Now, I get this all the time. Is life insurance a good investment or a bad investment? It's neither. It's simply a method or a mechanism for people to be able to use the tax code to put money into an insurance policy, whether it's whole life or universal life or variable life. There's all kinds of different options that we can use. There's not just one size fits all product in the life insurance world. I'm a financial advisor. I'm talking about this. I have a policy like this because it will allow me to pull out money in retirement completely tax-free. And when I die, my family will get whatever the death benefit is from the policy completely tax-free. There's some huge tax benefits of using tax-free cash value and life insurance as a supplemental income stream in retirement. Tax-free, tax-free. So, where do the big taxes start to kick in? They start to kick in when we're talking about our IRAs that are traditional IRAs, our 401ks, and our employer retirement plans, along with pension plans. Those things are entirely taxable when we take that money out. So we need to be thinking about this because at age 72, we are all required to begin making distributions from these accounts, whether we want to or not. The government requires it. It's called a required minimum distribution that you take from your IRA, your 401k, or your retirement plan. It's 100% taxable. The other place where a lot of people accumulate some money is in IRAs that they inherit. Maybe your parents have passed away. They've left you some money in an IRA. Under the old rules, you used to be able to take out a distribution every year from that account over the remainder of your lifetime. That's no longer the case. If you've received a beneficiary IRA in recent times, you now have 10 years to take all of that money that's in that beneficiary IRA out, and the taxes are due. The government is trying to get us to accelerate when we pay our taxes so that we can increase government tax revenue. So nice of them, isn't it? However, there's some strategies that we can work on to time when we take your beneficiary IRA distributions, because you don't have to take it every single year. You get to pick, and that's where the power lies. Knowing what year you should be taking this distribution, when you should start taking your IRA and 401k distributions, and in what year you should be doing the conversions from a traditional IRA to a Roth IRA so that you can minimize what comes out of your pocket and goes to the government in retirement. Every client that we bring on at Cary Stamp & Company goes through a rigorous analysis. We look at your tax returns for the last several years. We try to make recommendations of exactly how much your tax liability is going to be in retirement, and then we create a tax diversification strategy for every single client. If you're interested in learning more, you can email us at Cary, C-A-R-Y, at carystamp.com. You can call the office, 561-471-7700. And if you have specific questions that have to do with taxes in retirement, we're experts at helping people manage that process. Thank you.